Most people think that mortgage fraud is something that only criminals commit. Fake identities, forged documents, elaborate schemes. But here's what almost nobody tells you. Some of the most common mortgage fraud in America is committed by regular home buyers who have no idea that they're doing anything wrong. And the penalty for lying on a mortgage application is up to 30 years in federal prison and a fine of up to $1 million. And that's not an exaggeration, that's federal law. So today I'm going to walk you through the most common things that these buyers accidentally do that technically constitutes mortgage fraud, why lenders take this so serious, and how to simply protect yourself by being accurate. I'm Jacob Ballou, Las Vegas realtor, and my job is to make sure that my clients never stumble into one of these traps. So a quick disclaimer before we get started, I'm not an attorney and this is in no way legal advice. This is just education so that you know when to slow down and ask questions. So let's get into this. So first, let's talk about why this is such a big deal. So when you sign that mortgage application, you're signing a federal document. Right above your signature is language stating everything that you have provided is true and correct, and that knowingly making false statements is a federal crime. So most buyers sign it without reading it, but federal law makes it a crime to knowingly make a false statement to a lender to influence a loan decision. So the government does not need to prove that you were running a scheme. They just need to show that you knew a statement was false when you made it. And that's why the little stuff matters. So the number one accidental fraud that I see is going to be the occupancy fraud. So here's how it happens. You're buying a home and you check the box that says it's a primary residence because primary residence loans come with lower rates and these lower rate down payment requirements, right? But in the back of your mind, you're already planning to rent it out on Airbnb or move in for a few months and then lease it out or buy it for your adult kid to live in. You never actually intend to occupy that home as your primary residence. So checking that box is fraud. Lenders price a loan based on risk, and investment properties do carry more risk, so they charge more for those. So when you claim owner occupancy to get that cheaper loan, you're obtaining money under false pretenses, and lenders will check. They do post-closing occupancy audits, they look at utility records, they look at mail forwarding, and in vacation markets like Vegas especially, they absolutely watch short-term rental listings. So now life happens. If you genuinely intended to live there and a job transfer forced you to move in 8 months or whatever, like that's not fraud because intent is what matters. But if you knew on day one that you were never moving in, that's a different story. Number two is going to be the fake gift letter. This one's really common. So your down payment is short. So a parent or friend wires you 20 grand and the lender asks for the gift letter stating that the money is a true gift with no expectation of repayment. So you both sign it, but privately you've agreed to pay it back. The moment that letter is signed with a repayment agreement behind it, you made a false statement on a federal loan document. Why does the lender care? Because a gift does not affect your debt load, but a loan does. So if you owe your parents 20 grand, that actual monthly obligation is higher than what your lender approved you for. So the fix is simple. If the money is truly a gift, document it as a gift. If it's a loan, disclose it as a loan, and then let the lender factor that in because it might change your approval, but it keeps you honest and safe. So number three is going to be fudging income or employment. And this is easy. You put January when you really got hired in March, things like that. You lost that job then, but you put this instead. So making sure that you disclose that and then telling your lender if you switch from a salaried position to a commission position or self-employment during escrow, buyers rationalize this constantly. They think that it doesn't really matter. Or I made this much this year anyway. I'm going to make this year anyway on this new job. So who cares? The lender cares. Because to verify the employment right before closing and because the income type matters as much as the income amount. So a brand new self-employed borrower is underwritten completely different than a W-2 employee. So if your employment situation changes at any point before closing, call your lender that day, not after closing, that day. Number four is hiding debts. The application asks you to list all your liabilities. Buyers routinely leave off loans from family members, private loans that don't show up on credit, money that they owe on a handshake deal, or obligations like child support especially, and alimony. And here's the one thing that catches people during escrow: taking on new debt after you've been approved but before you close. You get approved, you get excited, and you go finance new furniture or a new truck for the house or a new car. Lenders pull credit again right before closing, so if that new debt shows up that you did not disclose, at best your closing is just going to blow up. But at worst, the documents that you signed confirming those debts not changing when they did. Now, don't buy anything on credit between application and closing. Nothing. We always want to wait until after we close. That way those keys are in your hand and then you can do what you want. But undocumented cash and moving money around, lenders have to source every large deposit in your accounts, partly because of anti-money laundering rules and partly because to make sure your down payment is not secretly borrowed. So buyers do get clever. You guys are sneaky. They deposit cash in small chunks to stay under the radar, or they bounce money between accounts to make it look seasoned. Structuring deposits to avoid reporting requirements is itself a federal crime, separate from mortgage fraud. So if you have cash savings, talk to your loan officer early about how to properly season and document it. There's almost always a legit path. The illegitimate shortcut is the one that ends careers and your freedom. So number 6 is going to be side agreements that the lender doesn't know about. And that's when you and the seller agree to something outside the contract. Like maybe the seller is going to give you cash back after closing to cover repairs. Or you inflate the purchase price so that the seller can hand money back to you for the down payment. Every dollar that changes hands in a real estate transaction has to be disclosed on the closing statement, on our final settlement statement. So undisclosed cash back arrangements are textbook mortgage fraud because they change the true price and the true loan to value ratio that the lender based its decision on. So if you want seller credits, that's great. We do those all the time. They exist, they're legal, and they go through the contract itself and appear on that settlement statement where everybody can see it. Number 7 is going to be the straw buyer. And this one this really destroys relationships. So a friend or family member cannot qualify, so they ask you to buy the house in your name. And they'll just make you the payments. It's fine, right? It's fine. And then that way, they really own it. So people do this out of love, but it's fraud. And because the lender approved you based on the belief that you are the true borrower and the occupant. But if the person actually living there stops paying, then guess what? You're on the hook. That foreclosure, potentially that criminal exposure, that's you. So co-signing through proper channels disclosed on the application is legal, but pretend to be their buyer when you're not, that's the crime. So what does the federal government treat this so harshly? Because mortgage lending only works on trust in documents. And the 2008 crash was fueled in large part by these loans built on false notifications. And the automated systems, these things that cross-reference your tax returns with the IRS, your employment with your employer, your bank statements with your deposits. The fraud people, they got away with that 20 years ago, but it gets flagged by software now. And you don't have to be the mastermind that got charged. You will still get charged. So signing the documents is enough. Now here's the good news, and this is the whole point of this video. Every single one of these traps is avoided the same way. Just be honest and disclose it. Total accuracy and disclose it. Everything the lender needs, give it all to them. It will not hurt your approval. A lower approval amount is a Tuesday. A federal charge is a life event. And here's what buyers don't realize, that the loan officers can work with almost anything as long as they know about it. So the gift funds, the job changes, self-employment, cash savings, family loans, there's a compliant path for nearly all of it. And the problem only starts when you try to hide stuff. So if you're buying a home in Las Vegas, in Summerlin, Henderson, or anywhere in the Valley, this is exactly the kind of thing that I walk my clients through before we ever write an offer. And I can connect you with great lenders who will structure your file the right way from day one. My consultations are always free, and there's never any pressure to sell you on anything. The link is in the description below. So if this video helped you, or you have a friend or family member who is about to purchase, they need to see this. Send it to them. Please drop a comment if you have questions about the mortgage process or any part of the process, because I will read these, I will get back to you guys. But please like, comment, subscribe, and I will see you guys in the next one.